Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, August 18th, 2023. It is 9:50 a.m. Eastern Times. I'm starting the video, so we're only 20 minutes into the trading day, and once again, I wanted to get a video out with my thoughts early. Yesterday, in the final post, I gave you some bullet points of things to watch, and those are going to be Treasury yields, key levels on, of course, QQQ. I'll start out here. Oh gosh, what else was it? We want to watch the euro, if I didn't include that. But what I want to do is just a super quick update on kind of everything lately. Everything being the trade ideas that I've put out there in the last couple months. I'll start out as I usually do with the equity markets, and then what I'm gonna do is we'll stick to the equity portion only. I already got you out posts on silver and gold today in GDX. Do with that what you want. I'll do crude oil, natural gas, everything else in another update. So let's stick to the stock market, but not only the equity markets, because so often it's just I find it amazing that's getting 90% of the comments and the feedback I get is just on the equity markets, and it is a big thing. I cover it most frequent, but I always say this: the money, the bigger gains are trading individual stocks or sectors. Because the stock market, if you think of the S&P 500, it's 500 companies in many different sectors. There's 11 primary sectors that make up the S&P 500, but there's a lot of subsectors within there. For example, healthcare, you have biotechs, pharmaceutical stocks, you have every variation thereof, and a lot of other things. Tech sector, you have technology, which is the biggest in the S&P and the NASDAQ, but then within there you have semiconductors, you have software. Excuse me. So there's all different sectors, and even within those subsectors, a lot of the companies have different business models. So my point is, when you go long or short an index, you are going long or short. If you go long the S&P 500, you're going long 500 companies in sectors that some have not only nothing to do with each other, but some are inversely correlated. You are going to defensive issue stocks, dividend paying, steady eddy stocks, utilities, tech. And so what it does is there's safety in numbers. You're never going to get clobbered in a single day on a big gap down due to earnings or some kind of financial, a news report that goes against your position. And then likewise, there's some safety there, but then again, it dilutes your returns on the other side. If you're long or short that index, again, when you're long the most bullish and the most bearish stock. So again, the takeaway is sector diversification, asset allocation, and especially in a market when we were topping here recently. I started highlighting my favorite sectors. I'm going to go through that in this order. So I started here with QQQ, stating that the NASDAQ 100 was my preference, just short, over the S&P 500. And let me just measure it out here. You can see from the highs recently, there was a sell signal early on in there, just off the highs on the first wedge breakdown. It's down about 8.5%, and that compares to the S&P 500, which is down about 6%. Right there, you can see from pop-up box to the left. So, and then I took it a step further and said, well, it's actually tech and primarily big tech that I favor. And I keep typing in the wrong one there. So XLK is tech. And so I said, you can instead, in lieu of shorting QQQ, because at the time I liked the healthcare sector, it wasn't that bad. There's your outperformance, 10.2%. And then I said you can take it a step further even within there. And the subsector, semiconductors, right here. And that one's down. SOX is down. And we got in pretty early on that. The last time around 12%. And then I also said there's those FANG ETFs. Of course, you could short the individual FANGs, but there's I forget the symbol. I usually just go individually because there's some of the FANGs I like better than others, such as Apple and all that. So we all know what happened to that. So what I want to do is give you levels where we're at today, where I think we're going. The charts look ugly. And so what's happened to the stock market is everything that weeks and even a couple months ago I started pointing out. My view was that I was taking what appeared to me being a extremely contrarian outlook to interest rates, where just about everybody was calling for a top, all the big firms, analysts, everybody else. And I said, no, watch, be careful with that. The market would be, and it's a big paradigm shift. These pension funds, hedge funds, mutual funds, actively managed accounts, they had it all wrong, and rates have gone up. And that is largely, if not exclusively, being contributed to this drop, because the economic data is still relatively good. We haven't seen any economic, in fact, there's been some strengths in some of the reports. And so this big drop off, again, make no mistake about it, nothing to do, because the Fed fund futures are pricing in a significant drop. And they have been for a while. And, a lot of times, remember, very few of you listening to my voice probably trade federal fund futures. I've done that. It's I forget the symbol offhand. It's you can trade the futures betting on what the Fed's going to do, where the federal funds rate's going to be. Usually done by the pros, by the smart money, and they've been betting it down for a while, and it hasn't jived with this strong economic data, which would indicate the Fed's going to stay high or continue to raise rates. So what the smart money is betting on, they must see some kind of market turmoil, and obviously I do. Told you, you think the market's going a lot lower in the coming months and even coming years. But so that's, just keep that in mind, that is short-term rates, has nothing to do with these long-term rates. This right here, this is where we were a few weeks ago, and I said it would be incremental, and so you had a little relief and the market thought we were okay, and then boom. But as of now, right now, and I still think over time these rates are going to go up. But as I've said recently, I even threw this out to be a trade idea. I think we'll probably see another pullback in rates. I don't know how much. Again, I've always talked about how these long-term treasury rates are set by the market, but in the short term, the Fed can intervene, and the Treasury. And I don't know if they will at this point. The market, if it continues to fall and starts to accelerate. And at some point they'll come in and do something. And then there's also that other thing I talked about, that market forces can bring, and will likely bring rates down, at least temporarily. Again, I try to frame everything in these time frames, because I think if I don't make clear, okay, Randy, are you bullish on rates or bearish on rates? Well, near-term bearish. I think even if we pop up here soon, we're going to pull back. And that will be because if we pop up, again, there's a vicious cycle, a negative feedback loop that goes on here. So if this goes up, interest rates, and we break out on the 10-year and we head up there, stock market's going to continue to throw a hissy fit. That I've predicted, and that's exactly what's happened so far. And again, as I said, it's incremental. The further you go, the worse it's going to be. Now, with that being, the stock market then goes down, and guess what happens? CalPERS and all these giant public pension funds and hedge funds and actively managed mutual funds, well, what do? They realize, oh, shoot, I was wrong. We thought, rates were going to go down and the stock market would have more fuel for the rally, and it was 180 on that, and so they have to then sell off equities and move money into safe haven treasuries, and buying those treasuries will push the yields down. So again, there's going to be, I don't think that we're going to break and run. If we did that, let me just say, that'd be catastrophic, and I don't think we're going to just crash the market right now 20-30% down in the next few weeks, but that's what would happen if we had a just blast it off here in rates. Is it possible? Sure. Anything's possible. Is it probable? No, it's the odds are higher now than they've been in a while, because you're seeing this rapid positioning, and it all, the majority of institutional investors and so-called smart money realize they're wrong, and now they're adjusting in their risk models and risk exposure. But anyways, that's where I think we're going. The technicals, let me go back to just the charts here, and then I'm going to go over all the trade ideas and give you my thoughts there. And that'll be, by the way, in this order: tech, XLK, SOX, everything I've covered, the big stuff, the market shorts. Then I went into the restaurants and the leisure sector, and that's a couple. I went over the individual, my favorite restaurant and leisure stocks. PEJ is a leisure ETF. I'll get to that. Then I believe next up, I said it's time to start shorting the home builders. Then just recently, a week or so ago, I said the financials. And so that's what I'll do. And well, here's QQQ. So let me just start there. It is in a precarious position. This is the daily chart. This is that level I showed you last night on the 60-minute chart. We're a little bit below. We'll call it 357 because I had it a hair above that on the 60-minute chart. I don't know if you can see that candle. I'll zoom in. We're right below it, but we're also on this, what I call potential uptrend line. See, I have the lows right here in the beginning of January. You had this other reaction low right here in March. If I extend that line, that puts us right there right now. Why do I call it a potential and not an actual trend line? Because in my book, it takes 3 reactions, distinct reactions, to validate a trend line. So we'd have to have a reaction here. And then it would be a valid trend line. Otherwise, you go through it, any 2 points can be connected at random. So my trend lines have multiple reaction points. These are all the old trend lines you can see here. All right, so that's it. So it doesn't look good because, again, it's only a potential trend line, and we're below that pretty good support shelf right there. And so that, we can snap back. All that matters on a daily and a weekly chart is how you close the day or how you close the week. Today's Friday. This is the 60-minute chart I gave you last night. So you can see, again, it's about 357. And, if you have to squint, which you do a little bit, you're right on there. And we have the potential to rally back, but we're below it now. So this is, and I've been saying this, a no-go for me. I'm not at any longs here. The only way we're going to bounce now is if we do this. And if we can't bounce soon, it's pretty bad technically because that's a pretty good support break. We're going to look at the market leaders in a second. Divergences will be taken out soon. They're starting to kind of right there, almost equal lows. So if we're going to rally, it needs to be today, I think. We closed down big today. And, anything's possible. Remember, it's Friday. Keep that in mind. Whatever you do, whatever you do today as a swing trader, even if you if you take overnight positions, even if you trade futures, you've got the overnight risk. The futures will shut down just like the stock market does on Friday and not open back up. Futures will open back up Sunday night. I don't have to tell you if you're a futures trader, but that's the only time they close. Other than that, they're going, around, from Sunday evening through Friday evening. They're 24/7 other than a 1-hour shutdown period from 5 to 6 every day p.m. So that's that. And the market will probably, with this volatility expanding, you're probably going to see a gap one way or the other would be my guess Monday morning. I think I'm still favoring the bounce, even though, again, wouldn't add yet. Add only if and when, and I think we'll get it. Is what I favor. I'm just telling you where I think. I think they'll recover today, snap back up. We'll see some bargain hunters step in because I made the case to the 10-year bond, CN and IEF. I gave you that yesterday. If that plays out and we start to see bond prices going up, the 10-year price, that means the yield's going down, and the market is going to like that. But I said it's either right or wrong. It's kind of my calls right now are kind of binary. If I'm wrong, then the stock market's going to go down. Yields are going to continue to go up. The euro can most likely continue to fall. Everything I got out to you today, those are the very correlated trades: gold, silver, the stock market, the euro, treasury bonds. And so this is what I'm favoring. And I'm going to talk on the other things right now. Let's get to that. But let me all right, I already showed you XLK and I showed you SOXX, but let me just mention, somebody asked yesterday, SOXX, I gave my 2 cents, was at support. What I'm doing here, you can see this trend line. Now I have this trend line drawn. Let me show it to you. Let me replicate it on another board, a clean board. So this is how I had that trend line drawn right here, and we're just below it. Now you can see a reaction there. If I want to do it, I can tweak it like this. And then if we get this reaction right here, then that's the reaction low. What I was doing coming a little tighter here. So the semis, again, they're technically below the trend line the way I had it drawn. But I always say this, the charts are dynamic and so is my analysis. So it's ever changing charts, technicals. If this is really, this is kind of like the market's last stand here. There's a lot of stuff that are kind of pushing overall, pretty bearish lately because we broke a lot of horizontal support. We took out the 50 days, but I'm still betting. I think I'm a couple days early on the call for a bounce. Sit tight. Just they're stretching my limits, but we're not much below. And I'm talking about the long bounce trades. And I'm also going to get to my other longer term swing trades here in a second, because there seem to be at least one member is very confused how someone can have longs, a long-term account and a short-term account. I don't know any active traders listening to my voice. I'm going to think you agree with me. You have an active trading account, whether you're day traded, active swing trading, and I'm pretty sure that's not what you do. I'm pretty sure you also have long-term accounts where you don't trade as actively, be it IRAs or a secondary, another brokerage account. That's what I do. I have multiple brokerage accounts and multiple retirement accounts and things like that, and I do trade different time frames on them. So that's what I'm going to get to, those swing and those longer term positions. I did book some profits recently, even on those, harvested some profits, but and took some hedges. But again, that's to me separate from active trading accounts, or my primary active trading account. So there it is. There's stocks, there's semis. Again, everything's in a position where if they can't reverse today, even right now, it's pretty ugly. I'll put a little, there's a little couple reactions right there, but it's just starting to get thin. And when I talk about that, let me show you what I mean. Thin support below. I'm going to turn up my volume at price histogram bars. No, those are volume bars. Where's my volume price? Here it is. Volume price. Turn these up and you'll see what I'm talking about. For example, on the semis here, this is stocks. See, this is a thin zone right here. This shows you the volume that was occurred at each price. Unlike the volume bars on your chart down below are your volumes every day on a daily chart. Each bar is how much volume occurred that day. But these bars show you how much volume occurred at each price level. And so when you have these thin zones, these thin bars, that's very similar to a gap. That's because the semis blasted right through there. That was on, I believe, NVIDIA's earnings right there. And it just went up. So very few traders bought. And so we're flirting right now. You see, I take it across here with the top of that thin zone. So we're in a precarious technical posture. So if they can't, if the buyers don't step in now, we get down there. There are no guarantees, but the odds favor you're going to have another sharp leg down, and this correction's not over yet, or at least not. Believe me, I still think we're going a lot lower. I've never waffled on that. It's a matter of, are we going to do this first and then that, or are we just going to go here and then that? And if we do, look, there's a great level right there on the semis, 446 and change. Okay, and then on stocks, I think it was 60-minute chart. I got a lot of boards. There it is. So there's also, you can see this is support right here. T1, there's that uptrend line. It's a 60-minute chart again. So it's a good time, in my opinion, to either cover the shorts on the semis. They're down double digits. You're at dual support, price and trend line. Or if you think we're going to go down a lot more without bouncing, without a decent bounce first, then lower your stops and you can hold out for that. I think we're still going to do this. That scenario, like I said, if it's going to happen, it really should happen today. I don't know if today, when volatility is high, you can close flat, but we'll see. I'll get you another update before the end of the day for sure. I just wanted to kind of show you that a lot of stuff is coming up at support, or like QQQ, maybe just a hair below where they can easily reverse it. And if they do and they get it back above those support levels, then you're likely to see a short covering rally, especially from all those Johnny-come-lately shorts I talk about that didn't want to short here and here. And I know there were quite a few even here. But now they want to, or they wanted to short here and here and here. And so if we do this, they start to go underwater quickly. All right, the other things. So there's my thoughts. Okay, so a lot of key stocks. Apple's looking ugly, but it's still, I had multiple targets. We're still plenty of downside. I have nothing's guaranteed, but I have very little doubt we're going to make it down to at least my third target here, probably here, and probably a lot lower. I believe a lot lower again, but it's not, it's not going to be a straight down move. Apple's a crowd favorite. It took out that first target. I added this support last night, so I've made a note here in case you say, well, that wasn't there before. 170.50, I just noticed. Pretty decent support. We're coming on that now. And so what I think is going to happen, I think they're going to step in and buy Apple and start buying the market soon here. But again, this big divergence, this is a big divergent high. I give you a lot of reasons to be short Apple. The weekly breakdown, big giant divergence. It tells me, all these other divergent highs have been well into the double digits, 20% plus in most cases. I've gone back for years, 40%, 34%. And so far, Apple, since it did almost identical technicals, broke a beautiful, clean, long-term uptrend line on the weekly following one of the biggest divergent highs in years. So do I think a 12% correction is all we're going to get out of that drop? Absolutely not. I think that's just the beginning. That's my belief, right or wrong. Bearish PPO crossover, everything that I covered recently on this. But is it going to go straight down? And it could. And again, I try to speak to the active trader versus the typical swing trader. If you're willing to ride out the counter trend bounces, you got a golden short if you shorted Apple pre or post earnings or post breakdown or right after. And again, I have some. You can see my long-term targets are way down here. Current final long-term target is about 82 and/or this primary uptrend line. So, if I'm right on that, then Apple still has, depending if and when it gets there, still another, let's just say it takes this period. It comes in at this 105.53 level. Remember, it's going to take time to get down there if I'm right. So you can see how the trend line, so I always talk about trend lines are dynamic. See how as I slide the slider, over time it comes in at higher and higher prices. So right now, if I had to just take a wild guess, or an educated guess, I should say, that's, comes somewhere like this, zigzag and work our way down here to 105.53 plus the primary. That's a long-term uptrend line, and that would be still a drop of 37, almost 38, close to 40%. All right, let's move on. I've got a lot to cover, so let's just go over where they are. So Apple, below support, I have different boards here. Let me go to this one. Below that was a pretty big support. This is that next support it's coming up on. I'm going to brighten that line up a little bit now that we're getting closer. Boom. Oh, there it is. Okay. So a little above 170 is the next support on Apple. That's not what I wanted. I wanted the other big fangs. Put this in order of market cap. Watch list. There we go. Apple, Microsoft, another one. Earnings. I told you, had that blow off top right before earnings. Then this was the earnings date here. Earnings gap or crap. Yeah, gap and crap. And it's just been selling hard since. Again, I can't make a strong case to step in and buy either of them. I can't make really a case at all to buy Apple. It's coming up on support if it goes a little lower. Microsoft really doesn't have any good support until the first really good support is all the way down here at 293.60. So this thing could get ugly, especially if rates keep going up. So, I'm telling you, I think there's a chance we can make that recovery today. But the odds at this very moment as I'm doing this video, I can't make that case strong until and unless QQQ gets back above, that support level I told you, especially if the indexes in the markets, the major indexes can take back the 50s. But the 50s are we put a little distance now between the 50s if I'm talking about the 50-day moving averages. So, so that's it. Alphabet starting to roll over. I had a price alert trigger today on its break below 127.15. So I'm thinking these are going to be whipsaws and the last of the suck in some, again, for just near term and get a little rally, kind of blow out these latecomer shorts and make them second guess this whole thing. And then we'll do that. That's what I'm leaning towards. So all that matters is how we close the day here. Remember, these are daily charts. So this is an intraday break. It's not unusual to see intraday breaks above resistance or below support, only to see that level recovered. But if it doesn't, it's bearish. As of this very moment, it's bearish. I always say a breakdown is bearish unless it fails. So that's that. So we'll watch it. These are all things to watch. Amazon, again, a lot of these trend lines. Amazon, some of these I didn't have super clean trend lines. This is my current trend line on Amazon, but there's a candle right there. Here, let me go to a clean board and I'll show you that. So this is what I was running, but I had a violation right there. So I'm going to now pull that down, and this is my new trend line right here. Okay, I'm going to put that on the home page, and so you have it at potential. But again, potential, just like QQQ and some other things, it needs to have a reaction there. I think we'll get it, but I wouldn't bet the farm. But if we do get it, we start to rally up, and we get back above support on QQQ, and there's some support on SPY and things like that. Then yeah, the case for a near-term rally would certainly increase. NVIDIA, they report on the 23rd. Keep that in mind next week. This is the king, the absolute poster child of the AI bubble right here. There was that big gap that took the semis up. NVIDIA, the charts indicate the stock's going a lot lower to me. And again, if interest rates keep going up, I don't care how that AI hype is just going to disintegrate, because the weight of everything else falling, the big fangs, the tech sector, growth, semis are part of tech. Tech's a growth sector, a cyclical sector, and nothing is going to put a lid on the economy like interest rates making multi-year highs. Mortgage rates just hit their highest rates, and what was it? I heard, I don't know, 30-something years. That was yesterday's headline. So that's it, guys. We're going to need to see rates pull back to give this market a chance to have a counter trend bounce, and if not, we could just keep seeing those rates go up. They extended the debt ceiling again. Treasuries, we all knew it was coming, had to be issued for that, and I think we're reaching that flashpoint where a lot of other countries and institutions are starting to look at the U.S. debt situation, say it's unsustainable, especially with these rising rates. Remember, the rising rates, we have to then continue to roll treasuries at higher and higher rates, and that's a huge debt service. And so it's a doom loop that we're in, I think, in the U.S. economy, and we'll continue to be in. But all right, let me give you a few other things, and we'll wrap this up. All right, so I covered the first thing. That was, a few weeks back, and then short tech, short semis, overweight semis in tech, and the big fangs, and that's played out. Then I went into restaurants. Let me just do EATZ was an ETF I told you could use. We hadn't yet broken down, but I figured we would. I can't remember exactly where I started highlighting it. I know it was back here several weeks ago at least, not a month or more, and that's dropped off. But I also, at that point in time, gave you my top picks. I went through all the charts, and most of them. I'm going to just put these to some of the names. So McDonald's, a lot of these I even laid out as official trade. I give you price targets. Already hit the first target. I can't remember where exactly. I know it was highlighted initially back here long before it broke down. It really was coming off all multi-year highs. And then there's the sell signal. So let's just go from there. So that's a quick, 3.5%, T1, T2, and a potential T3. And so, here's it. The common theme here is a lot of these stocks that I'm going to go through, not all, but a lot are at price targets, support levels. McDonald's also has both the 200 simple and exponential just below, and that was where it grabbed support right here recently. So yes, I do think it does this. It hits my second target, or I wouldn't list it. But it's a matter of, is it going to do this first? Usually you get a reaction off my initial targets on the initial tag. So Starbucks, this one I highlighted as a potential head and shoulders topping pattern, left shoulder, head, right shoulder, which is now fully formed. There's your neckline right there, and there's your measured target. So that one, I said on a lot of these head and shoulders, when I have a pretty good degree of confidence, I'll get in before it's even a fully formed pattern, anticipating. And then the beauty is when you start to see, like right here, and you start to roll over what could be a right shoulder, then you can just put your stop somewhat above. And so it's a great RR trade, one of my favorites, because even if the head and shoulders never gets formed, the stock does this, you have minimal loss. But if it starts to pan out, you push that trade, and then you add to it when you get the breakdown. That's the official entry. Most people wait for head and shoulders to form, they wait to recognize it, then they short, and that, again, that's a measured target. So there's Starbucks, but we're at, the neckline is support. So, and again, we probably bounce and then break down after a bounce right there. But again, a lot of these, are playing out. Chipotle, I gave this one T1 was hit already, and we hit T1, and now we're all, for all intents and purposes, hit T2. Close enough, maybe a little more downside, but this is one to take profits, right now, and then recycle back in on a bounce as an active trader. I think we will go on to hit my potential third target down here. So, these guys are playing out. This is a down 15%. Yum Brands, breakdown right there, down already 5%. But again, they were highlighted, many of these, way back long before they even broke down, in anticipation that they would. So here's another one, QSR. I had a target here at 68.59, and we're pretty much there now. Again, they were highlighted back here. That's about 11% drop so far. DRI, Darden Restaurants. There was our sell signal. First target hit right there, the trend line. That means TL means trend line. It's below trend now, but yeah, I think we're going to get that reversal today, is my guess, and a little stick stay by the end of the day, and then that may lead to some more upside next week in the market, especially if Treasury yields fall over the weekend. So that's it. So I still think we're going here. It's just a matter of how do we get there. All right. So just want to highlight these guys, and if there's a particular one that I covered before, I'm just rifling through the charts. Shake Shack, nice, one of my favorites, 15% down so far off that divergent high. Pizza highlighted, the overbought conditions, and we were right here in the video, said that's, overbought conditions in a bear market are like oversold in a bull market, usually one and done. So that one, I said you can short that overbought condition. If you did that, then you made so far 11, almost 12%. But look at that, we're at support. I haven't touched that line. That line was created back on the 28th of July. So, and that's a support level, which we just hit. Do I think we're going lower? Yeah, a lot lower. But, it's just a matter of probably going to get this first. Be my guess. I wouldn't bet it hard, but, let me give you a little, I see a little potential uptrend line there too. There you go. So we'll bounce off that, and then when that breaks and that support level, that'll open the door for the next leg down. Bloomin' Onion, Arco, breakdown back test. Look at that beautiful display of technical analysis, 14% drop. Jack in the Box, one of my favorites from the videos. Breakdown, and this thing never looked back, but it's come down to my second and only other target I listed. It's been about a 16% drop so far. So there's the story. Some just breaking down, others have already had a pretty good leg down, and they're probably due for a bounce soon. RRG, Red Robin Group, look at that head and shoulders pattern. Again, when did I highlight this? I made this back on the 1st, and that was right here. And I probably would have told you the same strategy. I already had the right shoulder starting to form, and that's what you want to see, an impulsive move down to complete the shoulder. So, had you shorted that one in advance of the, anticipation of the breakdown, you're up 32% right now. But you're also, I didn't give you have some support here. That's the measured target. I would have given. Oof, this is day 2. I did another pause of the video to collect my thoughts going from one chart to another, which I often do. And it's sometimes you click the resume button, it just doesn't take, and it's very easy to miss. I have a little box, the recording tools outside. You can't see it in the videos. So I don't know where I left off, but here's what I was gonna tell you. I went through, hopefully you caught it. I went through the financials, where they're at. Probably should do that now. XLF was one of the most recent sectors I highlighted as a short. Time to start shorting the financials. Primary bear market downtrend line, rejection recently, and then we took out the minor trend line there. Again, I may have already covered this. I don't know where the video is paused. Big bearish rising wedge on Visa, the largest. Visa hasn't even yet broken down. It's coming up to trendline support. I do believe it'll break down. I believe it's going to go a lot lower. This wedge would measure, widest part of the wedge would measure quite a bit lower, at least at 207, 208 level. But it's a matter of, do we bounce first, which I favor. JP Morgan, I mentioned that one, big divergent high, trend line break, minor trend line, and it's already dropped just in the last few days. This is the largest bank and the second largest component of XLF, the financial sector ETF, down 7%. But look, it's at support. So my common theme is I have many key stocks either at support now or just below where I think we're going to get that whipsaw. So what I was talking about when I realized the video was paused, just to kind of sum it up, and if I missed the home builders, I'm sorry. I did an interview. I did a coverage of that in this video. Hopefully you got those. Here's what I think is going to happen, and I've revised my trading plan, and that is this. I told you yesterday and the day before I would not add to any longs unless we recover the 50. I'm going to change that. This is very good support right here, or not very good, but pretty decent support, 357.60. It's defined by, when you look at the daily chart or the 60-minute chart I gave you yesterday, the reaction low from Monday, the June 26th, was 357.59. And then you also have multiple reactions from below right here. So reaction from above, reactions from below, and then this potential trend line. So my plan is to, if we get back above 357.60, I think it's going to trigger a near-term, a short covering rally today. I think the markets will rocket up today. Everyone's going to jump in and buy this. I was talking about a second ago, and forgive me if I'm repeating if the video was not paused. But this is what I often refer to as, what I believe it is what I call a momentum fueled overshoot. It's a term I made up when you have a near vertical drop or a rally going into resistance, but in this case, a drop into support. Let's say that 357.60 support. It is more than common to see a brief overshoot, break of that support, only followed by a recovery. The analogy I always use is a pitcher throwing a 90+ mile an hour fastball. It's going to hit the catcher's glove. The ball will not stop there. If you look at a slow-mo, video, the glove's going to, his wrist is, and the glove is going to snap back due to the momentum of that ball hitting, and then it'll spring back forward, back to where it was. And that's how I explain a momentum fueled overshoot. When you have a lot of velocity or downside momentum going, it's not unusual to take that out. So what happens then, if we recover, a lot of shorts probably stepped in and shorted the break of 357.60. Then it sparks a short covering rally, because those active traders that would do that, or even swing traders, would probably have their stops over here. You're also going to have bulls that have been foaming at the mouth for a long time to buy a dip on Apple, and they got the biggest dip they've had in a long time, even though it's not all the way down to that 170.37 support. I think worst case, if the market continues lower from here, you got a lot of Apple coming up on the 200 exponential. 200 simple is a little ways below, but you got really good support here. And so that's that. So that's my plan, guys, is to add, and we're almost there now. Going back to QQQ. This is a 60-minute chart. We're right there, 357. We take that back. You're going to have that trend line validated on the daily right here, and you're going to have this support level covered. So I will add and then have a very tight stop, no less than below today's lows, because if we do pop and it's just an intraday bounce followed by another leg down, that's going to be bearish. So I think it's time for them to do it. If they can recover that level, get a sharp rally today, and then what that's going to do is close the week on this level here. It's going to give us a reaction off this trend line, and more importantly, close us above that 357.60. And it's all related. I'm going to watch treasuries. I want to see ZN and IEF, the 10-year treasury bond prices going up, which mean yields are falling. Definitely want to see that. If not, it's a sign of non-confirmation of any rally. But price comes first and foremost. So that's what we're looking at. A bounce target right now, well, just like the 50-day and this 365 level were support on the way down, they've now become resistance. So that maybe if we do rally and reverse today, that's a potential target. It would be a bounce of grabbing the lows there, and that'd be about almost 3% reversal if we get up there, and that's a near-term target. But if we do, it's also going to be set the stage for more upside next week, I believe. Remember, the bounce targets were these potential bounce targets. I had a different downtrend line. I had a downtrend line off the highs right there, and so that to close back up above that support today could easily set the stage for a rally next week. get that bounce I've been looking for. Admittedly, got in 2 days early. Maybe I'll just end up losing. I'll be a, and again in the active trading account, it'll be a big, not a big mistake. It's not much. Milked most of this short down, but that's what I'm looking for now. And if I didn't say it earlier, should we fail to recover that level today and go down, especially with the weekend coming up, I don't see any reason to keep any longs, and I don't see any reason to add shorts. It's just too much risk at this point in time. The RR, this was a good time to short. We had a minor trend line break here. This was a good time to short. All these, the risk reward, think of the market or any stock or security like a rubber band. The more oversold you get but without a bounce, the greater the chance you're going to have a strong snapback rally. And so what I tend to do in this case, let's say I covered the shorts too early, I'll wait for the next objective entry, be it long or short. Long side would be a drop down to here, 347, if other levels confirm. And on the short side, I'll just have to look. I like to short bounces back to resistance once you're in a downtrend or breaks of support. All right, guys, I'm going to wrap it up here. And again, my apologies if I chopped up part of the video towards the end there when I paused it and didn't realize it was on pause. But I'll review it, and if I left anything out that I meant to cover, I'll definitely get another video out to you later today for sure and give you my thoughts before the weekend. Or even if it's static charts. I know a lot of you guys prefer just screenshots where you don't have time to listen to the video. So I'll do my best to get something like that out. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.